Now for a closer look at what's playing itself out in that market scene is Makwe Masilela from Makwe Fund Managers. Makwe, always a pleasure and a good afternoon to you.
Afternoon to you and to the listeners, to the viewers.
All right, Makwe, red screens in Europe, green screens here at home. It is a tale of two cities. Let's talk about that.
You know, I think back home here, we are continuing to celebrate what we've seen when it comes to remember we had a very soft CPI coming out of the US yesterday. But I think of importance, we have to just go back a week, to realize that since we've had that weak labor market report from the US, that itself started exciting market participants that, yes, definitely we should get a rate cut. Remember, at some point, we were worried that maybe it might be a hike up until they told us that no, you don't have to worry about that. But now also that CPI managed at least to confirm. And now we are talking people who are starting to expect almost 2 rate cuts now, from 6 to worried about a hike to 2 now. So I think it will continue to be data dependent. But when it comes to Europe itself, we've seen that they did manage to have a good run, but their earnings are not as impressive as they thought, and that maybe have a bit of a damper on them. And also that Japanese GDP number, the Q1 number, we cannot ignore that, that it was worse than expected, but we are trying to balance that with what is happening with the Chinese economy that we've seen since early this week or late last week with the issuance of long bonds. We've started seeing yesterday the guy stating that, listen, we have to encourage local governments to start buying those depressed or unsold units from the struggling developers and using loans coming from state banks. So you can see that there's some movement when it comes to stimulus from that end. So that as well is having an impact when it comes to the markets. But market participants will continue to make a mistake, getting excited from just one set of data, and the guys will know they need a series of data to be convinced that they've managed to win the battle.
I am, concerned, Makwe, that traders will once again lead themselves down, the wrong path in terms of seeing interest rate cuts, because like you're saying, the Fed has been very clear here about where they are. But we seem to be, getting these individual data points, moving the markets in another direction, getting another data point and possibly moving it in an opposite direction. Are we at this point not causing our own volatility?
We are definitely, but remember, volatility pays sometimes because now this is a trader's market. So you want prices to be moving up and down so that you can get involved, Yes, but ordinarily, you should be playing like a long-term kind of a thing, buy and hold, stuff like that. But truth be told, I think for the past year or two, that strategy, I guess it gets to be applied by very few people. But yes, market volatility sometimes gets to keep us busy for right or for wrong reasons, but that's a harsh reality.
Let's also talk on what we are seeing with emerging stocks there. I do see that we saw one of the emerging stock indexes rising by 1%. It's actually more than what we've seen in 2 years here. I'm wondering, Makwe, if, a possible downturn in inflation in the US might lead to emerging markets finding themselves in a more favorable position.
Definitely, because remember, number one, emerging markets, they've managed to resist and be resilient because ordinarily in a situation where interest rates are high and then we've got what is happening with the dollar, then it gets to be costly for those emerging markets to pay their debt, especially the ones that are in dollar terms. But now we've managed to see that there was nothing tumbled. So that a bit of resistance held. But look into the US stocks themselves. The valuations are just so perfect, price for perfection. So now you want those earnings to be able to be supportive of those high valuations. But while we're moving the US stocks up and other developed economy stocks high, people ignored the emerging market stocks. So now the question is, who has value? So value now is apparently when it comes to emerging markets.
Hopefully we can benefit from that, Makwe. Let's get into some company news now. Starting off with Karoo, the owner of Cartrack, double-digit growth really in all of the segments there. It really has been a stellar performance from there. I'm keen to get your thoughts on this company and even then being able to breach that 1 billion rand in operating profits.
Remember, people are trying to get more into digital platforms more than anything. And when it comes to fleet management, if you offer them a solution like that, then that's a win. We know that when it comes to a tracking device, some of the insurance companies, they require that as a condition to be able to insure you. So it's not surprising as well to see their car track subscribers increasing by 15%. I mean, I think the numbers are just sitting just around 1.9 million or so. Not too bad. Subscriber revenue going up, I think, by almost 17%. Operating profit as well improving 18%. And looking to their earnings per share as well, up nicely by almost 24%. Revenue up 20%. The biggest thing is the guys that are operating in a market that is largely under penetrated and demand for their services continues to be healthy.
Also keen to get your thoughts on Afrimat. They came out also with a very strong numbers here. Group revenue up at 23.9%. Of course, bringing, Lafarge South Africa online here. I think Afrimat, Makwe, proves to be a very impressive business that has managed to weather the storm, in a time when many companies that are similar, whether in mining, whether in construction materials, just haven't been able to, show the same.
And I think because they've got both, of those worlds, and that diversification is working for them and helping them to be able to withstand all those challenges. And you are right. I mean, if the guys are able to increase their final dividend by 40%, it tells you that the guys are making good money. If the guys, you look into their liquidity position, look into their debt equity ratio, sitting at almost 1.4%, 2023, it was almost 4.5%. But yes, we know that it will increase when they continue with the integration of Lafarge. But generally, this is a very decent stock, and the guys have managed to do well for themselves.
Brilliant, Makwe. I want to get your stock pick in a bit, but first, let's take a look at what counters your industry peers are also liking.
I'm going with Naspers. I mean, I know the share price has run hard in the last while, but I think this is just the start of tech recovery in China. So this is all Tencent again. I think the Tencent share price, the results came out yesterday. They were good. I think this is just the start of the some sort of recovery of China tech. When you look at how US tech is run, I think it's the start. So I'd go for Naspers, despite the fact that it's run very strongly in the last while.
I'm doing Nedbank at the moment. From all the banks, who are all cheap, historically Nedbank has probably got the riskiest loans. So if we, as a country, do better than expected, your gearing on Nedbank, as far as the provisions are concerned, is going to have the biggest financial effect. And I would expect that to outperform other banks.
Because I've chosen Combined Motor Holdings. It's a small cap stock, a market cap of around 2 billion rand, and it may perhaps be ignored by the market and certainly by institutional investors because tradability is low. But it recently released results which showed a consumer under pressure, and they discounted new vehicle sales because they had excessive stock, which has been a negative impact on margins. But the company trades in many of the well-known vehicle brands. It's well represented in the value segment, and it also has a car rental business, First Car Rental. I'm sure you've heard of that, which should continue to benefit from increased tourism and business travel. The segment has become more competitive, but its margins are higher than the vehicle sales segment. And importantly, it has an alliance with FlySafair Air, which has been very beneficial to them. They've also got a strong balance sheet. Cash resources were up by 7% to over 800 million rand. But looking forward, I think the oversupply of vehicles should lessen, which would allow them to do away with those excessive discounts that they're currently employing.
All right, Mark, we're keen to get your thoughts on some of those, Naspers, Nedbank and CMH.
I think Naspers, I tend to agree. Remember, the Magnificent Seven, which are tech stocks in the US, have been doing great. The Chinese tech stocks, not that great, and all because of regulators. They were coming with funny things. So I think maybe now, with them being done with all those penalties, some funny regulations, it's about time that maybe the Chinese tech stocks will start doing okay. And when Tencent managed to make money that side, we know that Naspers has got a very significant holding. Our banks, I agree, people are saying that cheap, and I'm not debating that. But my biggest problem is that the guys have managed to get good income, especially what we call interest income. But now we are at a point where consumers have tapped into the their savings, manage to lapse some of their policies or investments to be able to survive. So the problem is with this elevated interest rates, and that net interest income might turn out now to become impairments going forward. And I think the guys who released some of the interims have started to increase the interims. And when it comes to the motor vehicle sector, consumers struggling, they take forever to replace cars, but yes, those companies will continue to make good money when it comes to service and maintenance because you keep a car much longer. So I'm kind of indifferent on that one when it comes to combined motor holdings.
Well, that said, Makwe, which counter are you going with this afternoon?
I'll go with equities. These are the guys who hold, A-grade logistic buildings, in South Africa, in the UK. And we've seen that since the days of COVID, logistic buildings, warehouses have been on an increase. The demand has been great. And just the confirmation you can see, whether it's South Africa or UK, the valuation of their properties have gone up. The growth as well when it comes to the rental income has gone up. And of interest, the guys are sitting at a vacancy rate of 0%.
Wonderful, Makwe. An absolute pleasure having you with us this afternoon. Thank you so much for your time. That was your midday markets update with Makwe Masilela from Makwe Fund Managers.